Hey, everybody, this is Dan Passarelli, and we are going to get started here in just a moment. It looks like that moment begins right now. All right, I want to make sure that you can hear me before any introductions or anything like that. First of all, can you hear me? Give me a yes if you can hear me in the chat box. I got a lot of yeses. I like yeses. Okay, next question. Can you see my slides? See the arrow moving around up here on my slides? Yes, everything? Okay. Slides are good. Well, then guess what? We're going to get started. How do you like them apples? I'm Dan Passarelli, and today we're going to talk about how to use options volatility to gain an edge. This is one of my favorite things to talk about when I work with like one-on-one coaching students or other students of options. This is one of the things that I always try to instill upon them because, it's such a hugely important thing. Before we get started, I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading, and you can get a copy of that by calling 1-888-OPTIONS. All right, so here is how options work. So how do we know how much an option is worth? Well, the market tells us, right? It's called price discovery. It's what they used to call the efficient market hypothesis before people, behavioral economics poked some holes in that. But I think there still is something to the efficient market hypothesis. But the bottom line is, if I want to know what an option's worth, I look at the option chain. If somebody is willing to pay 98 cents for it and somebody else is willing to sell it at $1, it's worth 99 cents, right? Or at least at this point in time with all the information that's out there in the market. Now, that being said, professional traders will run pricing models, all right? Option pricing models, like you've heard of option pricing models, right? The Black-Scholes model, right? The American pricing model, binomial pricing model, there's a handful of them out there. The option pricing model helps us understand the value better. It helps us understand the difference between value and price, right? Because the bid is below the value, the offer is above the value. And it really helps us understand the influences on the value of that option. And American style equity options have 6 different inputs, and that's it. There's not more, there's not less, that's it. There's the current price of the underlying stock, which of course, you know, at any given time, you just look it up. There's the option strike price, which is static, it stays the same. There is the interest rate, which is pretty well known. The interest rate doesn't change that drastically, especially on shorter term options, to make much of a difference at all. We just set it to, well, pretty much close to 0 these days. The future expected dividend stream, which we can pretty much take a pretty good stab at most of the time. Sometimes you get surprises, but we can usually forecast out what that is. The amount of time until expiration, which of course we know, it tells us right there on our trading platform. And then the volatility. Now, we were talking about this, as I recall, either last week or the week before, about exactly what this word volatility means in the options nomenclature, if you will. So volatility has 2 meanings when it comes to options. There's realized volatility, which is also called which is also called historical volatility. And then there's implied volatility. And realized or historical volatility is the very intuitive one. When you think of the word volatility, that's what you're thinking about, right? It's how much the underlying stock has moved around lately. And we have to measure that in math. We can't just say, oh, kind of a lot. Oh, not too much. That doesn't really work for things like trading. We got to put a number on it. So what we use is the annualized standard deviation of the last typically 30 days of that stock. Basically, we take the last 30 or so closing prices, find the standard deviation, and then annualize that. So now we have this in terms of annualized standard deviation. Very, very simple. A stock that goes like this is going to have a much higher standard deviation than a stock that just kind of bumps along and doesn't do much, right? Now, implied volatility is the trickier one. This is the one that is so much less intuitive. This is the one that sometimes, well, a lot of the time, new entrants into option trading have a hard time wrapping their heads around this one. But it's actually very, very simple. All it is, implied volatility, is how cheap or expensive options are. That's it. If you just think about it like that, you're going to understand it perfectly. The concept of volatility is a breeze. It's how cheap or expensive options are. Now, how do we figure that? Well, let's go back a slide. This volatility, the unknown here in the options pricing model, if that option we were talking about that's worth a dollar right now, right, because it's 99 bid at $1.01, if it's worth $1 right now and all 5 of these influences are pretty much known, the volatility influence, it's this number that gets plugged into the formula, right? And the higher this implied volatility goes, the higher the price of the option goes. And the lower this implied volatility figure goes, the lower the price of the option. Now, we start with this idea, wrongly or rightly, and it's kind of both. There are things about this statement I'm going to make that's right and things about the statement that are wrong. The concept is predicated on the idea that people trade options based on expectations for future volatility. Okay? Now, what's right about that? Well, look, if a stock has earnings coming up, or there's a big important Fed announcement where there's a lot of uncertainty as to what's going to happen and what's going to be said, the market is nervous about volatility in this particular stock. You think they're more likely or less likely to buy options to hedge and to speculate? What do you guys think? If we expect more volatility, are we more likely or less likely to buy options to hedge? David says more. Dean says more, and Philip says more. Dwayne says, okay, well, we're going to talk about it. I'm going to kind of go through it. We've got a lot of folks saying more, a couple saying less. So the intuitive answer is more, but like there is a lot to this. All right. So don't feel upset if you said less, right? We're more likely to hedge against a potentially big move. Okay. The way we hedge is by doing things like buying puts, right? We're more likely to speculate by buying like a straddle or buying a call or buying a put to speculate. Because when we buy options, we have unlimited profit potential and limited loss. When we sell options, we have limited profit potential and close to unlimited loss, right? So when people buy things, whether we're talking about options or anything in the world, that makes the price go higher, right? It's supply and demand. So intuitively, we make this little connection that when the market expects, I'm making air quotes for those of you who can see the video, when the market expects volatility to be higher in the future, they buy options, which drives the price higher. Okay. Now, that being said, let's see how many folks we have in here. A pretty good crowd here, pretty good crowd. At this point, and tell the truth, and I'd like a lot of participation here, do you currently look at volatility before making an option trade right now? In your current trading, tell me the truth. Do you currently look at volatility now before making an option trade. Okay, got a lot of yeses. I got a good handful of no's. I got sometimes, some not reallys. Depends, always. Okay, so look, we're all over the board. Okay, like we're kind of all over the board here. So if a lot of you, I'd say, what is it, about at least 30% said, no, I don't. If you're not looking at volatility, but you're buying or selling options, then you're not, like by definition, you're not buying or selling options based on your expectations for future volatility, right? So not everybody does that. And so that means that that implied volatility figure that's factored into the option prices inherently has a lot of noise in it, right? Right? Because, you know, if there's 25 of you right now who don't use implied volatility in your decisions, and maybe you trade 10 lots on average, right? That's 250 contracts. Like, I mean, it creates noise and it makes the implied volatility figure not correct. Does everybody see that? Now, a lot of times when we hear, oh, there's this thing in trading, there's this number that we know to be not correct. What do you, like, where does your brain go? It goes, well, I'm just going to dismiss it. If it's not correct, I don't need it. Or I'm not going to follow that. Or, oh no, there's something wrong. Or trading is not fair. Like you start to, it starts to make you question the whole idea of options. But what this presentation today is about taking advantage of the fact that the implied volatility figure is not right, and then consequently, the value of the options is not where it should be either. Now that gets exciting because that ends up giving you the potential to have a statistical edge, okay? Now, one more thing about implied volatility before we advance to the next slide is that it's also stated in terms of annualized standard deviation. So then we can compare apples to apples, as they say, when comparing implied volatility to different time frame options or to historical volatility. Keep that in mind. That's going to become relevant in just a couple slides. So if implied volatility goes up, say, you know, from 27 to 28, 1 point, how much money do I make? I mean, I make one volatility point, but I can't go to the bank and you know, withdraw one volatility point, right? It just doesn't really work that way. You know, unless somebody comes up with a cryptocurrency called volatility points, right? It's the only way I can think of. But there is sort of a great translator, excuse me. And what that is Vega. Vega basically translates implied volatility changes into real money changes, into profit or loss for you. Vega is the rate of change of an option value relative to a change in implied volatility. And it's measured in dollars and cents. Now, in order to do a proper analysis, one of the first tools we ever want to look at, and we always want to look at this on every single option trade, is the the volatility chart. Now, the volatility chart, you're going to see some screenshots of some of mine. I have it sit right below the stock chart because the x-axis, that's the one going along the bottom, is time, dates, just like it is on a stock chart. But the y-axis, the up and down one, that is the volatility figure. Now, I like to use, when I look at this, I like to look at daily candles on the stock chart over a 6-month range. For having the volatility chart sit right beneath there, that's the ideal range and the ideal time horizon. And by the way, I see that there's some questions and such popping up. I'm going to answer all the questions later so I don't get off topic, okay? I've got a lot of great information. I want to make sure that you and I stay really, really focused on it so we can transcend our trading and get better at it today. So in order to use implied volatility analysis, we need to use what I call the MTM 1, 2, 3 volatility analysis. You don't need to know the name of it, but you do want to remember it's 1, 2, 3 steps. Step 1 is today's implied volatility above or below today's historical volatility? If implied is higher than historical volatility, there's a chance that the options may be overpriced. We still got to hit the other 2 steps. We're not sure yet, but there's a chance. If implied volatility is below today's historical volatility, there's a chance that the options may be underpriced. Now, take a little time out here, right? What does that mean, underpriced or overpriced? Well, look, if you want to go and buy anything, right? A new car, and you do your research, and this particular car that you really love is a $45,000 car, right? And you go into the car dealership and he says, well, yeah, this car, it's brand new. It has 7 miles on it. And we're going to sell it for $35,000, $10,000 below the value that you, from your research, see that it's worth. Like it's undervalued, right? So you would want to buy it. If that person comes in and says, hey, listen, if you go into the car dealership, the car's worth $45,000, and he says, oh yeah, you can buy it for $60,000. You're going to say, what are you talking about? And he says, oh yeah, there's a shortage of cars, and so we raised the price on everything by $15,000. It's overpriced, and you might want to bring in your used car and sell it because you can get a good price because cars are overpriced there, right? So it's the same thing with options. We want to buy when it's underpriced, sell when it's overpriced. Okay, so that's step 1. Next step is today's implied volatility in the top half or the bottom half of the 6-month range on the chart. So this is kind of the price of the option relative to itself, right? And I said that in a very provoking sort of way. I look at this as basically a measurement of the price of an option. Like I can look at the actual price of an option, but it's got direction affecting it. It's got time affecting it. It's got interest rates affecting it. And so if I just eyeball an option, I see it's trading at $1.23. I can't tell if that's cheap or expensive. How am I supposed to know? But I can see if relative to itself, all else held constant, that it's gotten cheaper or it's gotten more expensive. Now I've got valuable information. It normalizes the price of an option to kind of strip out the directional and time and interest and dividend metrics. And then the third thing is what's likely to happen to the actual volatility of the underlying going forward, right? Like if I'm a iron condor trader or let's just say I like to sell puts, cash secured puts, right? If I'm a cash secured put trader, if I believe that volatility is going to increase greatly in the future, I probably don't want to be selling cash secured puts. I'm less likely to sell it, at this price unless the price gets a lot more expensive. If I'm a cash secured put seller and like the markets come to a grinding halt, there's just like not much volatility at all, and I don't think that's going to change, I'm probably going to get more aggressive on selling puts. Let's rake in some income while the market's not moving much. So these are the 3 steps in the 1, 2, 3 volatility analysis. Let's take a look at how this works in real life. So this is a picture of spiders, SPY. In this period, implied volatility, well, you tell me. Was based on the 1, 2, 3 analysis, is implied volatility underpriced or overpriced? Who can tell me? Implied volatility overpriced or underpriced? Anybody? I know, I'm just throwing this at you right now. So for a lot of folks, it's your first time looking at this. Here's some answers. We've got over, under. We've got over and under and over and under. This is like that airplane bit, right? Over, under. So the red line is implied volatility and the blue line is historical volatility. So step one, implied volatility, today's implied volatility is above today's historical volatility. So that's an indication vol might be expensive. Step two, is it in the top half or the bottom half of the 6-month range? And it is in the bottom half, right? It did kind of tick up a little bit over the last week or so, but it's kind of in the bottom half in this picture. And then what do we think the volatility might be going forward? You know, and this is a hypothetical example, so you can't really answer that question. But like if there's a Fed announcement tomorrow, you know, there's a good idea that the market might move more, right? And don't get super hung up on that last bit. You know, if we're just kind of eyeballing it, not really ciphering to get an exact number, that's totally okay. So this is a little bit inconclusive. A lot of times when the market continues going up and volatility's been low for a while, I relax step two just a little bit, but for right now, stick to it. How about this one right here? All right, these prices are not current. This is FCX. Well, implied and historical are about the same. There's like barely any difference. They're about the same. And the implied is pretty much in the bottom of the 6-month range. So that's a little bit inconclusive. If I thought that implied, or if I thought that the stock was really going to move going forward, like earnings was coming, although it's not, because look, earnings came out a few days ago. If you're a user of this platform, you can see that. Or if I thought, you know, hey, we're going into the holidays, things are going to slow down. I think volatility is going to be low. That's going to help tip the scales for me either way. It's always a little bit tougher when things are inconclusive. How about this one? How about this one? Well, implied volatility is below historical volatility, and it's at the total bottom of the last 6-month range. If we're in a pretty complacent period and earnings is already out, Fed announcement already out, if we're in a pretty complacent period, this is definitely cheap volatility, and we'd be more inclined to buy options than to sell them. Now, that's a little bit of an oversimplification, right? There's a lot of nuance to that, and we can talk more about it. And we will, including and especially in the Q&A section at the end. But now I want to kind of shift gears and get a little bit more advanced, okay? I'm giving you some of my best stuff today. I'm giving you some of the most useful stuff that you can have in your arsenal as an option trader. This is stuff that I typically reserve to sort of my more elite students. We're going to look at skew. Volatility skew is the observation that options on the same underlying may have different implied volatilities. And when I say they may have different implied volatilities, I mean they always have different implied volatilities. Now, there's two types of skew. There's vertical skew, which is the skew among the different strikes, and then there's the term structure of volatility, also called horizontal skew, which is the difference of options with the same strike, but over different expirations. Let's take a look at how this works. Now, this is a pretty typical volatility skew. For most equity options, the volatility skew, there's higher volatility on the lower strikes and lower volatility as the strike prices get higher. All right, does that make sense? Now, there's some justification for this. First of all, what my one of my old bosses about 25 years ago used to say is, a put's a call, a call's a put. First time I heard him say that, I was, well, actually, I had read, I learned a fair amount before I heard him say that. And so it actually did make a lot of sense to me at the time. And I found it quite profound. A put's a call, a call's a put. Why? Because the put call parity stipulates that if I own a call and short 100 shares of the stock, so 1-to-1, one call to 100 shares of stock, if I own a call and short 100 shares of stock, that's synthetically like owning a put. And if I'm short a call and long the stock, that's synthetically like being short the put. Now, synthetically is just a fancy word for I have created a position that acts just like that other position as far as profit and loss goes. And so if you think about it, if someone is going to hedge this stock, okay, JP Morgan Chase, price they're not current, by the way. If somebody's going to hedge this stock because they own 100 shares, what are they going to do? They're probably going to buy puts, right? Now, I can, and I have done whole presentations on whether buying puts is the best answer, but that's typically what people do. If I'm going to buy a put to hedge this stock, what strike price would I use? 160s, 170s, 177.5 strike? I'm probably more likely to buy either at the money or down strikes, right? I like to buy out of the money puts typically because they're a little bit cheaper. There's a little more room, before they kick in, but they're cheaper. And so because there's this natural hedger's demand for these downside puts, out of the money puts, that means they are more expensive than the higher strike puts. And that also means that since these 160 puts are synthetically the same as the 160 calls, that the 160 calls are going to have a higher volatility than the higher strikes too. Now, what do people do sometimes when it comes to when the market's complacent? I think a stock's not going to move too much. They tend to sell covered calls. Covered calls is one of the most popular trades out there. And that means there's this natural supply on the upside calls. People sell the out of the money calls, which are synthetically equivalent to the in the money puts of the same strike. So that's why we see this in most stocks. Now, I did just do a podcast about 2 hours ago on FOMO in the market, and we have seen some of this start to change a little bit. There are a number of stocks out there where the upside calls are actually bid. They're actually higher implied volatility. There's a lot of demand for them. And if we have time, we'll talk a little bit more about those. So what does this really mean? Well, here's what professionals do when it comes to vertical skew. They kind of model it out, right? They say, okay, here are the strike prices and here's the volatility. And what they'll normally do is they'll kind of fit a regression line in there, right? And just look at the slope of this line, right? The slope of the skew is how we refer to that as. And then we buy or sell vertical spreads when the slope deviates from the norm, right? So if this is the normal volatility skew, about a half a point between each strike price, but it gets a little bit steeper. A lot of people come and they buy a lot of lower strike puts, the downside puts. Well, now it's about one volatility point between each strike. So what a lot of people will do, professional traders, is they'll do this. They will buy the comparatively cheaper upside strike, and sell the comparatively more expensive downside strike, and then just hedge it to get delta neutral, figuring that it will change and become back to normal one day. There's a lot of this concept of reversion to the mean whenever we talk about volatility. When implied volatility goes up, we expect it to come back down and revert to the mean or the average. When the skew gets more steep, we expect it to revert to the mean and come back down to the average. All right, so this is a way that volatility traders, professional volatility arbitrageurs will actually trade to make money from changes in implied volatility. Now, here's another one, term structure of volatility. So again, you remember what term structure volatility is it's all the same strike, but different expirations. Oh, this one didn't have the, these two further back expirations didn't have the 2 12.5 puts, so they're actually different strikes, but that's okay. You get the concept. Look, what we tend to see here is this. We tend to see this has a 21.76. This has a slightly higher volatility, slightly higher, and slightly higher. Sometimes we see it gets slightly lower, slightly lower, slightly lower, slightly lower as we go out in time, but this one is slightly higher. And I would say that this is probably more normal than the other. This is what you would refer to as a contango market, if you want to get fancy. And so what do we do with this information? Well, look, here's what professional traders do with this information. They observe, hey, for whatever strike this is, it's all the same strike. The May is a 34.6 volatility. This one has 29, 28, 4, 28 even. What does that tell me? Well, if I thought that implied volatility should be the same for every expiration, and to be fair, if I didn't expect the actual volatility of the stock to change, the volatility should be the same for each expiration until I believe it will change. How can I take advantage of this? Well, a professional trader would sell the May and buy July. Who can tell me, go down in chat and tell me what kind of a strategy this is called? What do you know the name of this strategy? You know the name of this strategy? Calendar. Yeah, that's right. We're assuming, a couple people said diagonal, but we're assuming it's all the same strike. Yeah. If it was two different strikes, it'd be a diagonal, but this is a calendar or a time spread. Good job, guys and gals. So look, this is how professional traders trade, right? The objective on skew trades is to make a couple of volatility points. Like what are we trying to accomplish here? Volatility is 34.6. This volatility is 28.4. That's a difference of like 6 volatility points. We typically expect the front volatility is more, moves more than the back volatilities. So what we typically expect is the front volatility, the shortest term volatility is what that means, to fall and reach the back volatilities. So that's like 6 volatility points. If the Vega, and here, let's go back one more slide here. If the Vega is 11 cents, if it falls 6 points, we're going to make 66 cents on Vega. So these options would go from like 225 down to 160, right? Yeah, that's about right. While these would stay the same-ish. So that's how they make money. But I mean, when they do it so that they're delta neutral. So they eliminate the directional risk. They have a spread, so they eliminate a lot of the time decay. In this case, they'd actually have time decay in their favor, and they're just looking for those volatilities to converge. So the profit is this. The volatility move, the crush, times the Vega times the number of contracts. So when I do these presentations, I would say the typical contract size is about 5 contracts. We have some folks who do 1 and 2 lots, a lot of folks who do 5 lots, a good number that do 10 lots, and then there's some people who do 20, 50, 100 lots as well. If you're trading 5 lots, and mind you, you're hedging with the underlying stock to get delta neutral, which ties up a ton of margin. If this falls 6 points, the Vega is 11, we would make $66 per contract. If you're trading a 5 lot, you make $300. You tied up thousands and thousands of dollars in margin, right? So professional traders trade this very, very big. when I was down on the CBOE trading floor, I would have thousands of contracts on doing this. So how can, and mind you, professional traders have extremely liberal margin, right? It's more like retail portfolio margining, which maybe some of you have. A regular trader, like almost everyone here, in a regular margin account, which is called Reg T, you can't even do this, right? So the logical question is then, Dan, why are you telling us about this? Why are you wasting our time? Oh, no, I'm not. Because this is how non-professional traders can benefit from Skew. Excuse me one second. This is Skew for the rest of us. Skew is extremely important in your trading. If you trade a spread, you're trading Skew. Strive to profit from it. Heck, even if you're not trading a spread, if you're just buying a call or selling a cash secured put, you're still trading volatility, right? When volatility goes up or down, you make or lose money. When the volatility skew shifts, you make or lose money. Now, it may be just 66 bucks a contract, but that was a $2.25 call. That's kind of a big percentage for a retail trader. If you're a 5-lot trader and you make 300, 350 bucks on a trade like that, you wouldn't have been tying up that much capital. Like, that can make a little bit of sense when it's part of a strategy. If we put on a time, so look, if a professional trader puts on a delta neutral time spread, they're expecting this crush to happen pretty soon, right? They don't want to make money from time decay. They don't want to make money from delta. That's why they hedge as much of that off as they can. They only want that volatility convergence to happen, take their money and get out. For a typical trader, like I trade a fair amount of time spreads. I put like 4 of them on just today. Most of the time when I trade regular conventional time spreads, my goal is to make money from that differential in theta, in time decay. Okay? And so skew becomes just part of that. Now, it may seem sort of esoteric, like, yeah, I've traded time spreads. I understand making it on skew, but does the volatility really matter when it comes to time spreads? How much does it matter? Well, look, time spread results are improved by using the term structure of volatility to your advantage. We use the volatility as a screen for time spread candidates. So look, here's an example. This is a time spread one could have put on an IBM, right? Maybe we think that IBM is going to stay in a range. Time spread traders, that is one of the criteria that you use, right? Maybe the main criterion that you use, right? It's been trading in a channel. If I put on a time spread, if it doesn't move too much in either direction, I'm going to make money from theta. But I can also layer this concept of skew on top of that. And if the implied volatility here is 20 on the ones I'd be selling, and the implied volatility is 1471 on the ones that I'd be buying, if the volatility does converge on the front and this falls down to 14 or 15 or so, I can also make money on implied volatility. Now, if you trade time spreads already, and if you're good at them, this can be a way to get even better at them. This can be a way to screen out the ones that are statistically against you. Like if these volatilities were flipped and I'd be selling the lower volatility and buying the higher volatility, I'd be at a statistical disadvantage. But here, I'm able to screen out time spreads and only trade the ones that are a statistical advantage. Now, this, I know, like this is very esoteric, right? This seems like, yeah, okay, I kind of get it. I trust you, but I don't know if I really, I don't know if it really makes sense. Here's what's important. Here's some numbers, right? So there's a little bit to this. I'd like you to try and pay extra close attention. Now, by the way, for those of you who are just learning about volatility right now, like this is an advanced thing we're talking about. If after this explanation, you still feel a little fuzzy, there's no shame in that. That is completely normal and completely common, and probably true for 95% of traders. Volatility takes it takes a little bit to get, right? But when you get it, it becomes your best friend, such a powerful ally. Okay, so with this skew, right, selling the 20 vol, buying the 14 vol or whatever this is, we can buy the spread at 62 cents. Okay, so look, we pay 149 and we sell it at 87. 149 minus 87 is 62 cents. Okay. If there was no skew, so if this volatility was not 20.32, it was 14.71, meaning it was 5.6 volatility points lower. What price would we have paid for the spread? Now, this is a really tricky question if you've never thought about this before, right? If the skew was, because you can calculate this, if this skew was 14.71, 5.6 points lower, well, how much would these call? I mean, these call values are the only ones that would change. The Vega is 6 cents. So all we do is we take 5.6 volatility points lower than this times 6 cents and subtract that out of this bid here. So 5.6 times 6 subtracted 5.6 times 6 is, hold on a second. 5.6 times 6 is 33 cents. So if we subtract 33 cents from 87 cents, that's 54 cents. That's what price we would be selling these as part of the spread, 64 cents, or excuse me, 54 cents. So if I buy these at still 149, but if I instead didn't sell these at 87, but I sold them at 54, I'd be buying that spread for 95 cents. 149 times 54 is 95 cents. But with the skew, I paid 62 cents. When I buy a time spread, what's the most I can lose? What I pay for the time spread, right? So with the skew, the most I can lose is 62 cents. Without the skew, if the skew wasn't present, the most I could lose is a lot more, 95 cents. It's 50% more. That greater cost means bigger maximum loss potential. It also means smaller maximum profit potential. It also means tighter break evens, which means a lower probability of success. If there was no skew, this would be 100% a much worse trade. And outside of that, we can make a profit in the short term if the volatilities converge. If the skew is here and I pay 62 cents for this, and later in the day, the volatilities end up converging, somebody realizes these are out of whack, the volatility arbitrageurs come in and they sell this, this spread would go to 95 cents. I could take my profit today or tomorrow. I could take it faster because of this. Do you see, and I would like your answer here, this will help me understand how we're doing here today. Do you understand why using volatility analysis and volatility skew is so powerful in your trading and can give you a great edge? Hit the chat box and let me know. All right, lots of yeses here. Russ and Steve and Dwayne and Carson and David. Okay, yeah, okay, yeah. And I got a couple people saying still lost, not sure yet. Understand why, but not really clear how. Sure. there's a little, and Cheryl's got it right on the money. She says, yes, but I need to practice including this. Yeah. So look, use a real example. Jake, this is literally a real example. This is literally a real example. So, oh yeah, and then somebody said, yes, but I don't do the exact calculation. That's okay, Ron. Like just knowing, like just having gone through the exercise with the calculation just lays the groundwork so that in the future, so that in the future, when you see that there's a volatility skew, you know it's a better time spread than if there's not skew or if there's reverse skew. Okay. So if you're still, if this still doesn't click, the good news is you're normal. But the better news is that it will click when you just sort of learn a little bit more about this, right? Go back and review this video. The good people at OptionsPlay record this and they send out the recording the next day, if I'm not mistaken. I believe that's when I see it show up in my inbox. And so, go over it again. Find some resources for learning about volatility. OptionsPlay has some great educational resources, right? Take advantage of them. I imagine most of you are subscribers at OptionsPlay. Take advantage of those resources and other resources, but start using volatility, start getting better at it. I mean, heck, look, even if I'm just buying a call, right? If I use my volatility chart to only buy calls when they're cheap and underpriced, when, kind of like this one here, hold on a second. And, like I'm just going backwards and kind of simplifying here, right? Like AXP here in this example, price is not current, had cheap volatility. If I thought it was going up and I bought a call, I'd be getting a really good deal on this call. My time decay would be lower because the value of the call is lower. I'm risking less and I can make just as much, if not a higher percentage. Or, this one was more overpriced volatility, not hugely overpriced, but it was a little bit overpriced. If I'm selling covered calls or cash secured puts or even credit spreads, this is a nice picture because I know that I'm selling options that are somewhat overpriced, right? I know I'm getting a statistical advantage because the value of the options are higher, my time decay is higher. Or even if I just hold them all the way to expiration, I'm making more than I would if volatility was lower because the options are worth more. So this becomes like, whether we're talking about just a really simple trade, like buying calls or puts, or a much more complicated trade, like a time spread, implied volatility is extremely important. And I have seen that the best traders I know use implied volatility analysis on all their trades. Not because it's the most important thing, but because it is yet another important thing, right? Like if you drive a car, it's important to have brakes. It's nice and could maybe save your life if you have like an anti-lock braking system that, is super high tech and does the braking for you and stops so much faster, right? Do you need that? No, but you want it. It's the same thing with any options position. Sure, you could go and buy calls just because you think the stock's going up and yippee, hopefully it works, right? Or you can be really scientific about it and select your strategy, which type of option trade you're going to use based on volatility. If volatility is really cheap, I'm going to buy calls. If it's expensive, maybe I'm going to sell a put credit spread instead. Both make money when the stock goes up, but I can gain an advantage. Like, would you rather start a race even with everybody, or would you rather have a head start in the race? This is what volatility analysis does for you. All right, we covered a lot. Let's take your questions, which is the most important and the most fun part of our presentation. Russ says, sorry, I have to go. My dog wants to go out. What? Did I have to know that, Russ? We just got a new puppy, a Morkie, that is 1.6 pounds. I could fit her like in my pocket, this little tiny thing. And that dog has to go out like every 15 minutes. And between every 15 minutes, she's going in the house. Oh my goodness. She's 9 weeks old. We're potty training her. Edward says, what platform are you using to get HV and IV graphs? You will find that on any options-friendly trading platform. This one happens to be Thinkorswim, which is one of the ones that I use. Yeah, I know my dog probably does need a diaper, but we're trying a housebreaker. Do I have a number to shoot for when finding skew opportunities? Oh yeah, good question. I like, I mean, with time spreads, I like the differential and the volatilities to be at least 2 points, but no more than 20 points. If it's more than 20 points, there's probably something happening that that I ought to know about that I don't know about. Is volatility analysis baked into OptionsPlay option recommendations? You know, I think so. That would be a question. What maybe once Tony gets back, because he is the brains, or if not one of the brains behind a lot of that stuff. So he would be able to answer that question better than me because he's intimately familiar with it. As examples, are these available using the OptionsPlay app? Yeah, same question for you, Charles, or same answer for you. What is high to low implied volatility average? Yeah, so between 2 and 20 points. When you buy longer dated options and sell shorter dated options, though IV is in your favor, how do you calculate the time value you play for the longer dated option? How do you calculate if it's worth it? Yeah, look, that's kind of what that's what I was mentioning earlier, is that if you don't use volatility analysis, there's no possible way you can tell. Volatility analysis is the answer. And now that you know that answer, all you have to do is eyeball it in the option chain. You should have your option chain set up with an implied volatility column. Wayne says, Dan, the OptionsPlay site doesn't show anything but an IV rank. That tells me nothing I can use. That's not true. That is step 2 in the 1, 2, 3 volatility analysis. If the rank is below 50, it's in the bottom half. If it's above 50, it's in the top half. OptionsPlay gets a lot of their data from comparisons. Okay. So those were the questions in chat, but there's more under the Q&A tab. And so I definitely ought to answer those. We're going to go backwards. Ron says, when stock reports after the close and thus the vol goes down, how is it really relevant since cannot take full advantage till the market opens? You wait until the market opens. I trade earnings time. I've been talking in the context of regular time spreads, but I also trade earnings time spreads. There's a lot of nuance to those, so I don't want anyone to oversimplify it. I've got 1 or 2 more presentations scheduled. If I get to do more in the more distant future, I'll do one on earnings for you folks. How do you, as a professional, use vol skew for time spreads to take advantage of higher IV in the front of earnings? Yeah, so Steve, I spent years and years as a professional. By some metrics, I guess I'm still considered a professional, but I trade in a retail trading account now. So I would say I'm not technically a professional trader anymore. When I was trading on the trading floor and trading legit as a professional, I would use it exactly as I showed you. Buy the cheap vol, sell the expensive vol, wait for it to come in, rinse, wash, repeat. But as a non-professional, we still take advantage of basically those exact same things, but just a little bit differently. the professionals focus strictly on Vega because they hedge off the delta and they try and hedge off most of their theta. They focus strictly on the Vega, volatility arbitrageurs. But us retail traders, right? I'm putting myself in that category. We focus more on time decay and delta, but we also use Vega for a little bit of extra edge. Jamie says, hi, Dan. So the IV times the Vega is the calculation in the formula to calculate the price of the, not to calculate the price of the option, to calculate how much the option price would change. You have a 10-year-old Schnauzer. Oh, that's nice. I have an 11-year-old Yorkie and a 9-week-old Morkie. And the Yorkie is still getting used to the little puppy. What is the HV/IV indicator that you're using? It's just a volatility chart is all it is. I set mine up specifically. I mean, look, most volatility charts out of the box will come 30-day implied, 30-day historical. I changed my historical to a 21-day setting because implied volatility is based on calendar days and historical volatility is based on trading days. So in a 30-day period, there's about 21 trading days. So it's more apples to apples that way. Lawrence says, hello, Lawrence. Oh, Lawrence is in some of our classes. How's it going, my friend? Lawrence says, in theory, volatility determines the price of time decay. Yeah. Good picking up on that little nuance. I kind of casually snuck that in there and you noticed, great job. Volatility is an influencer on time decay. Because look, if I've got an option that's worth $1, right? It's trading at $1. If Goldman Sachs comes in and buys 20,000 of these, that's going to drive the price of the option and the implied volatility higher. Maybe now they're $1.20. Okay. If there's 10 days to expiration, when they're $1, they're going to lose on average 10 cents a day in theta, right? To get down to zero time premium at expiration. It's usually a little bit non-linear, but let's just straight line it. If it's worth $1, there's 10 days. On average, it's going to lose in theta 10 cents a day. But if Goldman Sachs came in and bought a whole bunch of them, and now the price is $1.20, and there's still 10 days to expiration, it's going to lose on average 12 cents a day. So implied volatility does affect, not determine, totally, but it affects the value of time decay. What broker gives you vol charts? Yeah. I was using Thinkorswim, but I mean, Fidelity has. I mean, I think all of them have it. Like all the real options friendly ones. Could you show how to protect assignment risk in a time spread where your short leg is near the money, not too much time left? Yeah, I mean, that's out of the scope of what we're talking about. I mean, we are talking about time spreads, but I was kind of wanting to stick to just volatility. But yeah, I mean, look, I always close all my options before expiration. That's one thing that helps me avoid assignment. Sometimes if there's an option that's in the money, and I haven't closed it yet, have I ever gotten assigned? Sure, of course. But I like to try and avoid assignment. So if an option gets too far in the money and there's very little time premium left, I close it, whether it's for a winner or a loser. When there's no more time premium left in a time spread, the trade's pretty much over anyway. Hidden says, when you buy longer dated options, sell shorter dated options, though I answered that one already. How long will it typically take for the option Vegas on a calendar spread to come closer together? Yeah, so Dante, so two things. One, sometimes it could be a couple days, sometimes it could be never. If they never converge, does it still benefit you? Yeah, because it makes the time decay on the shorter term overpriced option higher. Carson says, is there an implied volatility times Vega number to show options that would benefit from volatility crush strategy? It seems that if Vegas close to zero, implied volatility difference wouldn't matter, and vice versa. If Vegas high, but implied volatility is, this is a long question. Let's keep questions short. Wouldn't have much but yeah, I mean, Carson, you're 100% on the right track here. But there's not a specific volatility Vega number, but your question is very insightful, and it brings to mind a couple of things we can talk about. One is, as we get closer to expiration, Vegas gets smaller. When there's like 1 or 2 days left until expiration, if implied volatility is just slightly, you know, out of whack, you're right. You're 100% right. It's not going to affect it that much. All the Greeks kind of go out the window on expiration day. So, but there's not really a volatility times Vega number, you know, because like if it's a $10 stock, their options are going to be very low price. The Vegas are going to be very low. If it's like Amazon, the options are going to be super, you know, have a much higher value, all else held constant, to a $10 stock. And so consequently, the Vegas are going to be a lot bigger. Some stocks trade normally at like a 10 to 12 volatility. Some stocks trade normally at a 50 or 60 volatility. So yeah, we can, yeah, it's a really great question, but there really is no number like that that we could use. Are you only looking at volatility in isolation? In reality, price comes along with volatility. What's your outlook on price with given volatility? Yeah, that's the idea. That's the idea, is that you look at the value, like value you observe, price you actually trade, right? So if the implied volatilities are out of whack, the values of the options are out of whack, I can sell the option to take advantage of that. Can I elaborate on how purchasing in underlying makes you delta neutral by buying a calendar spread? Well, most calendar spreads are in and of themselves delta neutral if they're at the money. So that thing about delta neutral is not necessarily about calendar spreads. I mean, calendar spreads can have a small delta, but like, look, if I buy 10 calls that have a 60 delta, right? 10 times 60 is 600. So that's like I'm long 600 shares. I would short 600 shares to get delta neutral. Now my directional risk is gone. Is the IV and HV hold on a second here. Okay. Is there a video that shows how to create those volatile? No, and like here, look, guys. I don't want you to get super hung up on every detail. What I really want everyone to walk away from here with is I want you to walk away with a deeper understanding of how this stuff works, and then the very specific tools that you might use or might already have access to. You know, you can grab those. You know, I'm glad to answer questions going forward on this. The good folks at OptionsPlay might have some answers, you know, as to where you can get some of that on their site as well. You place a greater importance on IV rank over IV percentile or vice versa. Well, different websites call different things. I was inferring that IV rank and IV percentile are synonyms. And if that's not the case, if some platform differentiates those as two different things, let me know and we can talk. Wayne says, Dan, this is great stuff. Question, how are the individual strike price implied volatilities calculated under each expiration? Yeah, so it's really, I mean, there's a fair amount to this answer. We could do a whole hour on this, but the real answer is it's by supply and demand, okay? Because if somebody like buys the 50 strikes and somebody else sells the 60 strikes, like that's going to cause a little bit of a difference there, right? It's going to cause the 50 strikes that are bought to be a little higher vol, and the 60 strikes that are sold to be a little bit lower vol. And that's why you see that, because people tend to sell the upside calls and buy the downside options. That said, they're not always valued like on a retail platform perfectly. So I always like to sort of smooth them out. And there's different ways to do that. That's a little bit out of the scope of what we're covering here. We got pretty advanced with a lot of stuff. And I'm trying to keep this at a good level where new folks can grasp some concepts, even though some of it might be a little over their head. And really experienced folks can still grasp some great concepts, but maybe not solve all the world's problems in 1 hour, right? Fidelity has a screen that will pull up HV versus IV. Yeah, that's right. They do. So, yep, if you're a Fidelity person, definitely use that. Okay. Well, that, ladies and gentlemen, is everything that I have to share today. Next week, I've got something special for you. I'm pretty sure that when I was talking to Tony a month ago, he said that he's not done anything like this before. We're going to talk about how to find short squeeze candidates. And that is going to be super cool, man. That's my favorite strategy. I put a couple trades, short squeeze trades on today, and I'm literally just going to go and tell you my secrets next week. So make sure you show up, and I look forward to it. I hope you do too. This has been a presentation of OptionsPlay in conjunction with me, Dan Passarelli from Market Taker Mentoring. If you want to follow me on Twitter, go to twitter.com/Dan_Passarelli. Or if you're an Instagram person and you're a visual learner, or you just like looking at cute puppy pics, because I post those sometimes, you can go to instagram.com/market taker mentoring. This is Dan Passarelli. Trade well.